You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody, that funky tune means it's time for the Funky Show on the old network. It's time for TWIFO. This Week in Futures Options, where we get funky with what we said, futures options. So some crude, maybe some metals, maybe some ag, some indices, whatever flavors, pick your poison. We'll talk about it here on the show this week. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Quite a few shows for you guys to listen to. So if you're listening to the TWIFO on the old podcast, make sure, if you haven't done so already, make sure you upgrade to the full kit and caboodle. That is the network feed. You get all of, I think, something around the neighborhood of 15 shows. Even I've lost track over there on the old network. We'll keep you busy, daily news, all sorts of stuff for advisors, active retail, education, futures options, volatility, you name it. We got you covered on the old network. Again, subscribe wherever you're listening to this. Make sure you got the network feed rolling. If you already got it, ballyhoo for you. You get a gold star. If not, get on over there and do some upgrade. And while you're there, whatever platform you like, Leave us a review if you're so inclined. Maybe you have some good stuff to say about me, maybe a little not nice stuff to say about Nick. It's okay. We like it. We can handle it. Send it up over there on your platform of choice. 5 stars across the board, of course. And, of course, speaking of listening, you guys can always join us live every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern, via Mixlr, MIXLR. I know a bunch of you were in there for the Vol views. I think there's some Mixlr issues going on right now. And I know some of you are reporting that the stream was kind of cutting in and out for you. So we did reboot it. Hopefully that will help. But if you're still encountering issues in there, let us know. Again, that we don't run that at the end of the day. We send the stream, but it's not our service. So hopefully it works. It worked well up for the last show. So hopefully they'll get their stuff together for this show as well. Let us know if you're having issues. Meanwhile, though, let me introduce my cohort, my partner in crime, the yin to my futures options yang, Mr. Nick Howard. Nick, welcome back to TWIFO, sir.
Hey, glad to be back. I'm a little rough voice today, but I'll do my best to make it through the entire show.
You're always rough and gravelly, sir. That's part of your charm. It's part of your appeal.
Yeah, more rough than usual today.
It's always something fun over there in Quick Strike land. That said, listeners, you can always play along as usual. CMEgroup.com/TWIFO, TWIFO. That's where you can generate all these cool reports that Nick and I are using throughout the show. If you're wondering yourself, if you're scratching your chin saying, how do they know that the double calls in WTI, spoiler, are the hot number one with a bullet option for this week, you can do that yourself. CMEgroup.com/TWIFO to learn more. All right, Mr. Nick, let's do a dealer's choice today. There's a lot of things we could talk about. So what are you feeling? What are you feeling in your belly that you want to start with here today? Which product is catching your eye?
So I think let's go to our old faithful, with the pun intended, some crude oil. What do you say about that? And then maybe we'll jump over to an ag, and if we have some time, we can take a look at gold, since we've had a fair amount of activity, at least in the futures.
All right.
Over the last couple of weeks.
Crude, ags, and gold. I think we could do that. Listeners, if you have some questions, something you want to see, I know some of you have been asking about ags, so we'll get to those, I think, today as well. But we'll kick things off in our old standby, our old faithful, as Nick alluded to, crude. And, the question for crude has been, ever since it broke the 50 handle, will it stay there, or will it retreat back like it has pretty much every other time since the big OPEC meeting back in November of last year really kind of set us off on this new trajectory, this new paradigm for crude? And spoiler, yes, it can. It did finish the week pretty much up about a handle or so, depending on where you're looking. Some of the farther off handles a little bit less out there in the term structure, but pretty much up about a handle out here. So a decent week for crude bulls, perhaps not as much as they wanted, but on the flip side, it didn't retreat down to 48 or something like that. So that's something certainly to write home about. And people have been asking us what's up with crude vol, and crude vol kind of coming off a little bit this week, as it wants to do, for a couple of reasons. We've said this before. Typically, the puts are more bid than the calls. From a vol skew perspective, it's kind of reminiscent of an equity or an index in that sense anyway. So typically, downward moves equal a little bit more juice out there, whereas upward moves, again, typically, usually mean vol coming off. Again, if it's a sharp move in either direction, the paradigm is going to shift a little bit. And this week was kind of a net upward move, not too aggressive. So we saw vol coming off a little bit, but not a ton, not a huge vol apocalypse or anything out there. Vol already is pretty anemic out there in crude land, particularly, again, frame of reference, bear that in mind when we're looking at it from a 52-week or maybe even a 2-year perspective. It looks pretty anemic, but as Eric said when he was on the show recently, historically, if you go back in time with crude vol can get a lot lower. Crude vol right now, where you're looking is, somewhere in the, mid 20 handles out, 26 or so out there for kind of at the money implied out there in WTI, but it can get much lower. It can get down to 14%, I think Eric was saying, or lower there. So it has drifted lower in the past. So bear that in mind if you're looking at it from a 52-week chart and saying, oh, crude's at the bottom of its range, I want to load up on some premium. That trade's been rough to hoe over the last 6 months or so. Every time you've seen a little spike in crude vol, it kind of comes right off again. So it's been challenging for premium buyers, even if net maybe some of the delta moves have worked in your direction. But it's been a challenge for premium buyers. So don't just look out there and say, oh, the vol's getting tagged, we should go load up, because it hasn't worked out too well, at least not yet. If you're going to do that, at least do some spreads and some other things, try to offset some of your net outlay. Because if you're just loading up on premium and hoping for the next big bang in vol or movement, chances are you might be disappointed. I'll let Mr. Nick break down the skew in a minute, as he likes the old quick skew, telling you what's going on, puts and calls independently. Imagine that. they move independently. Maybe someone should break it down that way. Well, Nick and his team have done just that with their patented, patent pending quick skew. No C, leave off the C for cool. All right, moving on to what was lighting it up out here in the old CME WTI contracts. And it was, again, the Nove doubles kind of leading the charge this week. We said this for a while. It used to be 45, 50. It seems like 50, 55 is kind of the new paradigm for where the action is, where the hot, upside and lower bounds for price action, and of course for options, strangle, risk reversal, call it what you will. That seems to be the case again this week. Double calls leading the charge, nearly 35,000 hitting the tape this week. The lion's share actually on Monday, 13,500 going up on Monday. So pretty interesting paper up there, almost half just in that one day, and about another 7,000 on Wednesday, and the rest of the week, Tuesday and Wednesday, Thursday, about 6,000 each. Today pretty anemic, only about 1,100. And that was a lot of back and forth paper, as you might imagine. That double strike pretty active because only about net closing about 2,500 on the week. So a lot of back and forth churning on that double strike. Will we hit it? Will we not? Show that over right there. What's going on? Double strike, clearly where the action, 55 for those of you who don't know what I'm talking about with double, 55 strike is where the action. Sometimes the lingo just slips out. You don't even know you're saying it, listeners. And you've been doing it for a while. Number 2 out there on the list, a little bit south of that, though, were the 50 puts. So remember I said 50, 55. It's kind of been the active strangle risk reversal again. Those are the I call them our near-term Bollinger Bands here, and that's kind of what we saw again this week. 50 puts, number 2 with the bullet, 25,000 and change, so about 10,000 less than the double calls. Action still clearly net on the upside. Again, with the Lions, actually pretty even throughout most of the week, about 7,000 and change or close to it. Monday, Tuesday, and Wednesday, and Thursday. Pretty much only today being the outlier, about 2,200 contracts. So a pretty active week on that 50 puts, and net opening, nearly 7,000 contracts opening this week. So new players pouring into the 50 handle. Maybe they were waiting to see if this was the week that it could maintain above that 50 level, and when it did, they started piling in. Interesting stuff out there. And then we actually fall off a little bit. Actually, it's kind of interesting. For number 3, we actually go out a few months, actually. It's not in the Nove anymore. It's out to Dees. Dees, where we see the 60 calls. So again, a little bit of a call narrative unfolding out here this week in crude. Maybe, again, maintaining that north of 50 handle for another week. Maybe that was enough to entice some action out here in the call wings. 60 calls out here in Dees, trading it up this week. 19,000 and change lighting it up, including nearly 11,000 coming on Wednesday. That was the big day. The lion's share of that Wednesday actually was closing. So someone closing out maybe that 60 handle. Maybe they didn't get the move they were hoping for and deciding to close out the Dees, or maybe it was a bit of an overriding and taking some opportunity to take some of that off the table. Either way, Wednesday, nearly 11,000 of those bad boys going up, and net closing nearly 5,000 total on the week on that strike. So people taking some money off the table over there in the old 60s. And in case you're saying, well, what about some of the a little bit farther out of the money puts? They had you covered out there in June of next year as well, all the way out to June 2018, where we saw the 45 puts. So getting a little bit outside that band of the 50-55. We saw 60 on the upside, 45 on the downside. 45 puts lighting it up to the tune of nearly 16,000 this week. The big day coming on Monday, nearly 7,000 going up. So almost about a little less than half of the volume going up on Monday alone. Then 4,000 on Tuesday, about 3,700 on Thursday. Today, nothing. 91 of those puts going up. So it was all earlier this week. Total of nearly 16,000 on the week, about 3,000 and change opening on the week. So pretty active stuff. And it's interesting, a little bit of a variety in the strike selection this week. If you want to get a little bit funkier, you say, what about some farther out of the money, a little bit more optimistic, longer term plays out here in WTI? I did see some of that as well. The 70 calls, fairly active, but in Dees of 2018. Yes, 7,000 of those bad boys going, including about 5,000, actually 5,001 printing on Monday, opening, a good chunk of those opening, 3,000 and change opening, and about 2,000 going up on Tuesday, and a couple hundred on Thursday. So 7,000 total. Again, about 4,000 of that opening on the 70 strike. Dees 2018, maybe that trade doesn't look as far-flung as it did a few weeks ago when we couldn't even break the 50 handle. And let's see, we've got a couple of crazy outliers here. Let's find, here's the fun one here. This is June of 2019. Yeah, we're going pretty far out now, listeners, going a couple of years. And we got someone putting on about 1,000 of the 35 puts. So not everybody is feeling the upside love, the downside still getting some action. 35 puts going up 1,000 times, all of that on Monday, all of that opening. So someone opening in June 2019, 35 puts 1,000 times. Mr. Nick, weird paper, kind of pick your poison across the board. If you find a strike and find an axe to grind, someone's out there grinding it. So interesting stuff. What did you make from this week in crude, sir?
Yeah, I think what I was really paying attention to was what kind of level we hit in terms of a high price or a low price and stuff like that. So our high this week was very, very brief, 52.76, and I think that occurred yesterday's trading. It 52.86 was a high, and we came right back off of that. So we really didn't get any continued push on the upside, and that would more than likely relate to the fact relate why the volatility had just come in. So I'm sure that over the last couple of days, if I go look at my contract summary here and see what it looks like, I can see that, we just kind of bounced around and vol probably had a little bit of a push around that high print. And then after that, we just came off in general, and a lot of it came off probably end of day yesterday and the balance of it today. So again, like you mentioned, I tweeted out a 5-year 30-day at the money volatility chart a few minutes ago. So that will give you some levels. You're right. We're not down. Excuse me. We're not down at our lows. I think we were low as 7.6% back when the future was around 90 or 92, 93, 94, something like that. So with a range of, what are we looking at? A range there of $6 or $7 versus a range of about $10 now, or $12 with this 52 futures price. So we are not quite as low from an overall perspective standpoint, but we are pretty low nonetheless. Really, my big takeaway from here in general is everything outside of the November contract. If we're looking at our quick skew numbers, we see that the calls got cheaper and the puts got more expensive. And again, probably to do with a lackluster rally or an inability for the rally to continue on the upside. So people saying, all right, well, that's about all we're going to see again. We go back to, I think was it Andrew who said it, or 52.5, right? Is he the one who said that a long time ago?
It was Matt Bradbart, I believe, from RCM.
Matt Bradbart. Okay, there you go, Matt. Sorry about that, Matt. Props to Matt. We still really haven't reached for very long that altogether. So, I mean, we were probably up there for a couple hours yesterday, but that's about it. And we haven't been able to hold that. So, calls cheap. As we go out, the skew didn't change all that. Well, the skew puts got more expensive and the calls got generally cheaper, but we saw that cheapness be a little bit greater in the front three contracts. So that's really, that's really the big takeaway from my standpoint on the volatility end. If we take a look at, the quick skew chart, we see that channel is it's not quite as wide as it's been from a December contract standpoint or from a November contract standpoint, but it's still showing us as being a little bit, calls kind of indifferent. People are selling them and puts are kind of bid, because I think once we reach the high end without going through, people are going to say, all right, we're done. So we're going to get ready for the downside to come back. And that's kind of what's happening here. I'm going to take a look and fix this guy so I can look at it a little bit better. Right. So that's really it. I mean, you hit on all the good, most active stuff. The 60 calls in December, that was 25% of that was closing. So there was some trade around that, right? So people probably took advantage of the fact that we ran up and hit some of those highs of late. So they're getting out of those calls. Might be the only chance that they get a bid to those calls to get out of them. So, and then there's other people just sort of churning around. So, but 25% of those is on the close. So don't know how important that strike is so much. And like you mentioned, a big one out in D's 2018, we had those 70 calls. So those are always interesting as well. So 65s too traded, but we're still in our range. And I think what we're going to see is if we look at our open interest for some of these contracts after this week, we are more than likely going to see that 45 to 55 range get tightened a little bit. And, since we still have, like in the December contract, we still have the high put is the 45 put, but right behind that is the 50 put. So we might even tighten our range even further here to this 50, 55, 55 plus. So just looking at things, it appears to me that until we breach 55, we're not going to see much activity in terms of a big vol push at all. And then after the 55 strike, it's going to be 60. So we got quite a bit to go before I think we see any significant increase in volatility. And on the downside, we got a natural barrier at the 50 strike, and then again at the 45. So I think it's doldrums for the crude, even though they talked about extending the OPEC cuts and stuff like that. None of that rhetoric has ever helped this market, at least in the last year that we've been talking about it. Maybe briefly for that announcement day, but after that, nothing. So that's all I'm seeing there in the crude right now, Mark.
Yeah, no, Nick, we're always asking people what they want us to talk about, and they're always giving us crazy things like lean hogs and stuff. We got some people, and this kind of goes in with what we've been talking about lately, wanting to get the ags back on, so I'll bump one up from the question section to now. We got T-Mal asking for our thoughts on ag vol, particularly corn, wheat, or soy. Let's kick it off with corn, because we can decide how much ags we want to get into after that, because corn's been doing some interesting stuff of late. Nick, again, you guys can follow along, cmegroup.com/TWIFO, and then make sure you just select corn from that drop-down menu, and then you too can play the home game of TWIFO. And looking at it again, the corn futures up a wee bit, up about 0.75 of a percentage point this week, so nice little run to the upside there for corn. Not huge, but nothing to sneeze at either. Also seeing vol coming off a little bit, kind of across the board. Again, it depends on where you're looking on the term structure. The very near portion getting crushed, but again, the near portion of that term structure, it's mostly gamma. It's not really vol at that point. Where you get a little bit farther out, things about a bit of a mixed bag, but mostly easing a bit on the vol space. I'll let Nick get into the old skew in a minute, because the ag skew is always an interesting beast to break down how that really looks. And in terms of what's been lighting it up out here, number one with a bullet this week coming out here in Dees. And again, we know the ags kind of have their own rules of engagement. They tend to trade around their harvesting and production and planting cycles. So a little bit different when we see in the term structures. It isn't always just all front month all the time. It kind of is spread out a little bit on the term structure, which is a little bit interesting. Like in this case, we got the Dees lighting it up. And number one is actually on the downside, the 340 puts, with about 18,000 going up this week. The lion's share actually coming today, about nearly 8,000 going up today. And that's, again, a lot of back and forth, because it's pretty much net close to unched on opening for this week. So clearly a lot of back and forth printing on that strike, as corn has kind of been vacillating near there as well. And also the 350 puts, so a little bit meatier. A little bit richer there, also lighting it up this week to the tune of 16,000 and change. The big action there actually coming on Wednesday, about 5,000, nearly 6,000 going up on Wednesday, about 4,000 today, and about 4,300 on Thursday. That's pretty much the lion's share of that. And again, most of that is a little bit slightly opening, but not a ton. So clearly a lot of back and forth, churning and burning on both of these strikes. Then we get for a tie for third, it's kind of the 330 puts on the downside and the 360 calls. Again, all of this in Dees 2017 listeners. Both of them doing just a tick over 14,000 contracts. Let's start with the calls first. The calls doing a slightly more with 14,222, the lion's share of that. Coming on Wednesday, about 4,200 and change. Thursday, slightly less than 4,000, about 3,500 on Tuesday, and not much going up today there at all. About 2,000 of that are close to that opening, so a little bit more net opening on those strikes than we saw in some of the others. Similar story for the 330 puts, which is again about almost 14,200 as well. About 7,000 going up on Tuesday, so pretty much half of it going up on Tuesday. The rest kind of scattered throughout the week. And again, net about 2,200 contracts opening there on that strike as well. So some pretty interesting paper lighting it up. Let's see if we can go a little bit farther out and see anything really exotic lighting up the contract months. We see a little bit of paper on the 380 calls out there in March of 2018 to the tune of about 7,000 and change. Actually, most of that seemed like it was pretty much closing, because there's net only about 450 opening on the week. So I guess someone coming in deciding to maybe unwind some of that, so 780s out there in March, and beyond that, not a lot lighting it up. The weeklies doing some paper, but not a ton out here. It doesn't like weeklies are the big driver for action out there in corn, which is kind of, I think, a similar story for a lot of the ags. I don't know how much the weeklies are really tearing it up when so much of the paper is focused on the monthlies around that, planting and harvesting cycle. Mr. Nick, any thoughts here? We've been kind of glancing at ags, even though we haven't really worked them onto the show in the last month or so. What's catching your eye out there from a skew perspective in corn, sir?
Yeah, I think just looking at it in general, I mean, you get a lot of action in the futures, in the corn and the beans, and the wheat has been a fairly popular product out there of late. But I'm looking at the volatility, just taking a look at the overall levels of the at-the-money volatility, the 30-day counts maturity. It's kind of just in around. It's a little bit below its mean volatility over the last year on the 30-day. So. More, to me, it looks more like a trending around an average than anything else. Again, vol pretty flat this week. That tells you in and of itself what's going on. If there's not much, it's down quite a bit today. So it was up on the week and then down today on the front contract, and that was really where the action was here, when you start to get the separation between the old crop and the new crop. As far as skew goes, and the quick skew numbers, which again you could see out there right now. I did liven the links up out on the CME Group's version of the TWIFO report, so you can click through and see those charts and see how it's reacted over the period of time. So the corn for the December skew, this is probably as tight as it's been. So it's something to keep an eye on. So we're looking at the calls are generally flat to the at the money more or less, and the puts are a little bit cheap. But if you look at the trend overall, typically over the last year for that D's contract, the calls were around 8% rich and the puts are around 8% cheap. Again, that's looking at the 56-day contract. If I come out here and look at the counts of maturity and look at the 60-day contract on the quick skew, and I don't think you guys can see this just yet, although I have an announcement about that. We are also as cheap as it's been in a while. So the call skew and the put skew in relation to the at the money right now is as tight as it's been in a long time. So we had some really a real widening of it around the beginning of May. About this time last year, it was about as tight as it was. So kind of probably makes sense around the trade for the summer. So if that's the case, then we're probably not going to see too much going on the 30-day skew if history is repeating itself. And what I could do by that is go look out a little bit further and see if that's going to be the case. So yeah, I don't know. Right now it looks, I think that there's some, we'll have to keep an eye on it. That's probably going to be good. There'll be something for us to keep an eye on in corn and check to see if the skew is going to get a little bit more rangy than it has been, or at least what it was last year at this time. Other than that, you didn't see tremendous change in the shape of the vol curves over the week. And that's about it from my standpoint. Good, solid increase in open interest around 3%. Decent range of strike trading, as you mentioned. And for now, that's about all I got.
Always fun to mix a little ags into the mix, so to speak. I guess we'll round it out then with, I know you wanted to hit on some metals. Obviously, this is an interesting week for some metals. We got the Fed talking and everything else, and all that macro stuff is afoot. That usually means the metals, gold, particularly the precious stuff, also moving, a little bit. And we saw gold just coming off of some of its recent highs, off about 10 handles pretty much this week, right around the 1285 level. For this week. So all of you gold bugs who were loving all this stuff north of 1300, we're back below that level, at least for the time being. Also seeing some of the vol coming in, like representative again of some of the little bit different skew we see out there in the shiny stuff, where a lot of that bid is actually to the upside calls. So when we come off a little bit, we actually see vol retracing a little bit, and that's kind of what we saw out here this week. So everybody is always used to, investment skew and equities and in index options. This kind of stuff usually surprises them, but that's par for the course here, particularly in some of these metals. And again, they can move. Those skews will evolve over time as well as crazy things develop. But typically, usually a bit of a bid there to the upside. I'll let Nick break down the skew in a minute there. Pretty active week overall with open interest up nearly 7.5% out here in the big NYMEX NYMEX corn, that'd be interesting. NYMEX gold options here, including number one with the bullet. Just because we sold off Mr. Nick didn't keep everybody from all the gold bugs from coming out to play this week with the 13 half calls out there in Nove, really leading the charge out here this week, doing a total of about 21,000, including 16,000 on Wednesday. Of course, a lot of that tied to our friends over there in the Fedland, and the rest of the week kind of light. So it pretty much was all Wednesday with most of the action. And the lion's share of that 21,000, actually only about 2,000 of that was closing. So a lot of back and forth. Again, not surprising given the fact that we had a big event for gold players out there this week. And then it kind of falls off quite a bit after that with actually moving a little bit farther out to the Dees 2017 1400 call. So like I said, the upside player is not quite done yet, even though a lot of them were closing. Maybe giving up a little bit of that near-term ghost. The Dees 1400s, a lot of them saying no mas this week. Total of 16,000 going on the tape, about 3,000 and change of that closing, including 12,000 of that on Monday. So they were coming in early for these, which is kind of interesting. Maybe getting a little bit of an early hint of what was up this week. Either way, a lot of them deciding to, and a lot of back and forth. At the end of the day, net closing about 3,000 contracts out there. So perhaps some folks deciding to live to fight another day on that 1400 strike. But still interesting activity out there in Dees. Also right behind it, again, the 13 half strike also in Dees with about 16,000 and change. Just a couple hundred contracts separating these two strikes. And again, Monday being the most active day, 9,900, almost 10,000 going up on Monday. So maybe a little bit of a vertical 13 half, 1,400. Maybe I'll let Mr. Nick dig into his block trades there for Monday while I keep breaking this down. Again, the rest of the week pretty light. Total of about 16,000, again, over half coming on Monday. And again, about a little over 3,000 in the closing. So it could have been perhaps a closing vertical that went up out there on Monday that drove a lot of that paper throughout the week. In terms of weird stuff, though, if you go a little bit farther out, things are also pretty active. Let's go out to June of 2018, where we also saw a lot of paper, in particular 14,383. So actually a little bit more. This actually would have been number 3 here for the June 2018 1500s. Yes, 1500 strike. I read that correctly, 1500. Total of, like I said, 14,383. Again, Monday being the active day, 11,446 going up on Monday, about 2,500 total closing on the week. So perhaps some interesting paper. Of course, June also a time frame typically tied to some Fed prognostication out there. So probably not a coincidence that a lot of paper going up in the Dees and June time frames. Interesting stuff. Don't usually see in gold that much going out all the way out to June of next year. But this case, that was the case. Not to be outdone, we also saw all the way out in June 2019, we saw the 14 quarters trading about 5,000, actually 5,300 times this week, and also the 12 quarters trading 3,000 times, both on Monday. So take your pick, 14 quarter, 12 quarter, two very different strikes out there as well. So some weird paper pretty much across the board here, Mr. Nick. Again, a lot of it focused on that kind of near-term upside and some crazy upside as well. Anything catching your eye out there in gold? Gold's always a fun one to talk about with skew this week, or just in general. So anything catching your eye out there in gold skew this week?
Well, I'll get to that in a second. I think the other thing to take notice of, when we look at the volume and the open interest, the most active column is showing what led the charge from a strike and volume and open interest standpoint. But if you click on that 1350 call, for instance, in the November contract, and you look just down the top 10 list, you're going to see that the 1335s traded quite a bit this week, and you got an increase of almost 10,500 in open interest. So that was an interest as we started to rally back up again. They sort of reined in where they were looking, and you can think of it as them looking at the 1335. We also see, as Mark mentioned, a 1350 settled, and then we had the 1375, which also had an increase in open interest. And Mark said to take a look at at some of the block trades out there, I don't see any of the 1335s in the block trade anywhere, but you do see a lot of 1370s and 1350s. So that new block trade tool will be out on the CME Group website fairly soon. You'll be able to take a look at that for yourself and filter it by product, by asset class, and all the way down to the particular options. It's going to be kind of a nice, easy tool. And at some point, it will be just a click away on probably TWIFO as well as the rest of Quick Strike. So 1335, 1375, I like to look at not just the volume leader, but also the OI leader, and then how those shake out in comparison to the rest of the strikes on either the call or the put side. So some bigger openings on the upside. So as much as we, I was look back at the futures chart on this as well, we're back down at a level where we were probably a month and a half ago, and we're still above when we got as low as like 12.16 in the future. So can't seem to hold the rally there. Not enough of a crisis or any kind of statements being made by one government or another to keep the push towards the toward the gold upside, but. And again, we're seeing the same thing. We get a little bit of a bounce, and then people might run up on it, but then they crush the volatility. So we see overall the volatility is down, and when we're talking about it, we're down at the 10% range for the 27-day option. And if I go out and look at quick vol and look at the 30-day option overall, take a look at this. We are, over the course of, what's my date range here? I got a couple year date range. We are pretty much not on the lows, but we're nearing the lows. So we can still see some downside. Our lows came when we were near the 1200 mark in the future. So I think that if we continue to see a slide, we're going to continue to see an at the money slide in the volatility as well. The skew, we had a slight uptick in the call bid and a little bit of offer in the put side. So again, that could very well be, the change. It's kind of not a big change from last week, but still, I think people want to be long that. They're going to, with the expectation that we might still continue to push. I see the dips as a buying opportunity for the physical or for the underlying, and I also see the vol dips back on the bottom end of the vol range, the volatility dips, and then we're back on the bottom of our futures range. I like those as opportunities to get long premium at cheap prices. The puts are offered, so you can get in there, hedge them, and if we run back up again, you have a scalpable option position, you have a good margin position. And if we continue to break, or there's some sort of big decline there, you have cheap volatility where you're going to move away from those puts. Those are going to become calls. The skew of the curve will work in your favor from holding a volatility standpoint. So, I'll continue to say, I've been saying it for a long time. When we get these dips in the gold underlying, and we're not near our lows, but as we do, I think they're something to watch. Buy puts, buy futures, hedge them, scalp the gamma if we move up. We go down, they hold their value pretty well, given how low we are in the relative volatility levels over the course of the last couple of years. So that's what's catching my eye there.
All right, before we move on to your questions, I'd like to break down what is winning the week, and in some cases losing the week as well, from all the products listed over there on CME. It's quite a few. They trade a lot of different products over there. What's just net winning the week? What's net losing the week? Again, this is just pure underlying performance. This is not vol. This is not anything else. Just looking back over the week that was, our winner once again, winner wearing chicken dinner, is lean hogs, up nearly 5.5% this week. We'll have to get them onto the show. Maybe next week we'll break down some hogs. I think we have a livestock question a little bit later if we get to that. Also, the Russells, E-mini Russell 2000, up nearly 3% this week. Too bad we missed the Russell boys this week. They could have been on talking about all things Russell out there. Lumber, easy for me to say, number 3, up, a little bit north of 2%. And then on the downside, we got soybean oil taking it on the chin, off 4% this week. Rough rice off about 3%. And then feeder cattle off 2.6%. So there you go, winners and losers for the week. But you know who is always winning, never losing? It's you guys with your great questions, because it's time for the Futures Options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to the Futures Options Feedback, the portion of the show where, like it says, you guys get to dictate what the heck we talk about here. Hey, you already got some of them up there asking us about ags. So already got some love there in the first portion of the program. Let's see what we've got here. We're just talking lean hogs. Got this question here from Florentia. She perhaps wants to know, hey, I heard a few mentions of the livestock products being difficult to trade. What makes them so impenetrable? And this, I think, probably refers to something we were chatting about on the show last week. We've said before, too, I think I've relayed this story a number of times. I've never traded them personally, but I know a lot of people who've tried to make heads or tails of them, including a lot of them coming from the traditional equity and index options world, places like the SIBO and others who've been trained in those options and kind of viewing all things an option as an option. So whether it's an option on a lean hog or an option on the S&P, what's the difference? And then they get out there to a product like the lean hog or some of the other livestock products, and they realize it is a different beast for a variety of different reasons. The trading hours are different. The order flow is markedly different. I think that's a big driver. You have to really understand who the players are out there, what they're doing, and what the regular, pattern of that flow is. A big index like S&P, you have kind of flow hitting you from all sides, so you can kind of maybe you can kind of parse that a little bit easier, whereas the hogs are sometimes very unidirectional and the livestock, and the certain players are doing certain things at certain times, and if you're not familiar with that, you're kind of missing out on the lion's share of the opportunities out there. It seems like it's very concentrated around a handful of players who have been out there and trading these products and hedging with them for quite some time. So if you're not really too conversant in that scene, it might be kind of impenetrable to the outsiders. I don't know, Nick, do you know anybody over the years who's tried to dive into those, and has their impressions pretty much been the same?
Yeah, I think it's a tough one for newcomers to walk in there. I have some friends who spent a lot of time on the floor or a lot of years and went over and started to, at least from the future standpoint, initially tried to trade the outrights and really got ripped up pretty good and ended up moving toward trading spreads. Okay, so doing the live cattle or the feeder cattle spreads, because those had a great deal of movement, even though they were spread against each other. So the outrights, I think, were pretty difficult. But I think the spreads were still difficult, but they gave you a little bit more safety in terms of the amount of range that you could have. And I had some relatives that were brokers in that pit, and I think it was difficult to break into the network of good old boys that existed in there as well. So, all in all, given the difficulty of the outrights and then the whole atmosphere that was down there, I'm sure that there were a lot of newcomers that weren't very welcome. But my stories of success that I've heard from my friends that have been trading for a long time has been to trade the spreads and not to trade the outright, because you're going to get enough action in those alone without getting too beat up on the outright prices.
Yeah, trading crowds by their definition can be somewhat insular, not too welcoming of new additions, and you get some smaller, more specific products like that, or the crowd kind of knows itself, and they've all been trading it for some time. That makes it doubly impenetrable to a newcomer. But interesting about the spreads, maybe that's a little bit more reasonable way to enter into these products. But interesting stuff. They've been moving a lot, so maybe we'll get them on the show to talk a little more about all things what's lighting it up out there in the hogs and related products. All right, Timz, he wants to know, hey, this kind of goes back to what you were saying before, Nick. He says, it seems like there's no reason not to collar, maybe double negative there, no reason not to collar gold if you're long. This is something we were talking about before. We had the OIC collar study. That's kind of some of the best data on that, even though it is a little bit dated now. And that showed gold, kind of running away with their performance there. But a lot of it is kind of what we talked about before and still kind of exists to a large degree in gold. The calls are bid. And so that's a nice scenario for someone who's overriding calls all the time. You're getting a lot more premium for that, and the puts are a little bit cheaper. So you're able to buy better protection for less cost, and you're getting more to sell the call. So you're kind of right in that sense. It is an ideal, just all shape, slope, all that stuff aside, compared to a traditional thing like an S&P, it's definitely a more favorable place to set up and do collars because you can probably buy them for less, or if you're lucky and got good strike selection, maybe even put them on for a credit, which is ideal. Now, of course, the flip side of that is if you're buying gold for a lot of appreciation, the collar is going to clip that. So bear that in mind. The OIC collar study structure had a monthly call writing with a 6-month put. That seemed for them to be the good nexus of pushing out the decay a bit and also collecting a lot. I think if that study was done today, it probably would be a weekly call with a somewhere in the 6-month put. So again, that's gonna be a little bit more work, more commissions, but I think over time it's gonna net out to do better for you. But if you're okay being that active and being able to maximize your decay on both ends of the spectrum, yeah, I'm with you. If you're long gold, it makes a lot of sense to collar it out there in that product. Mr. Nick, your thoughts? You were saying before you like having some puts, so the collar is not that much of a stretch from that. What are you thinking here for our friend Timz?
Yeah, I think right. If you're long to physical, or if you want to get on the future, I think the puts are inexpensive, and like I had mentioned, especially around these moves back into the lower end of the range. And then as far as financing those with a short call, again, you can probably look at what the futures range has been over time and pick some pretty decent strikes, start to deliver or start to sell some premium above those strikes with the expectation that if you did reach those levels, you'd be glad to deliver on your physical. So it's I don't want to say that it's trading like an index. That's how an index. Well, no, it's vice opposite there. You have a little bit better premium than you would on the index in terms of most of the index people doing the covered. They're doing their covered calls because they own the underlying and then selling it to selling the cost to get a little bit of a dividend premium. But you do get the skew to move around in the gold. Right now, it's like we said, the puts are cheap and the calls are expensive. So you can say that's probably a good point. It is sort of a natural collar, but again, I look at it as more of easy protection, cheap protection. But if you wanted to finance some of that, you could definitely finance it with the calls. And there probably are, if you watch the quick skew numbers, there probably are better times than not to do that. And then you can really pick your strikes accordingly to the point where, you can pick a longer dated call based on what the range have been of late. So you can get a little bit more premium even still, right? So definitely something to watch, and definitely something that we've obviously been watching with the quick skew numbers over the last months of our podcast.
Oh, come to the dark side, sir. Sell the call. You can do it. It's okay. It's all right. It's all right to do it, sir. It won't be scary. But I'm not going to make blanket obvious recommendations. Everyone should do collars on this and that. But if someone asked us, like Timz does, if there was one asset that leapt to mind that was uniquely suitable to putting on collars all the time, gold would be at or perhaps the top of that list. So it is an asset that is well suited to that position, more so than if you go on try to put on collars on all of your S&P positions. That's going to cost you. So yeah, gold relatively well suited to that trade. Perhaps why it won the day in that collar study. Good question there, Mr. Timz with a Z. Very fancy. This comes from another one. Comes here from Contemps. This is getting us, Twyfo's got to be the Bitcoin show apparently too, Mr. Nick. And Contempt says he was on the CME Group homepage this afternoon, and he says looks like they are starting to feel the love for Bitcoin over there as well. And he includes a screen grab from their market data summary on their homepage, which includes block trades, as you might expect, and then some data from their Clearport, a lot of it on the interest rates side. And then right next to it, a big chart, a big reference of CME Bitcoin products, including their Bitcoin reference rate, which at the time of this screen grab was 41.55, and their Bitcoin real-time index of 4,074. Let's see if it has the time. This is from the 29th, so today at about this is late. This this is right around, I guess, midnight. So this was last night, but still, interesting stuff here, Mr. Nick. So it seems like everyone we talked before, we have in the past about some of those the other exchanges starting to get into the fray with Bitcoin. It seems like there's just a lot of groundswell of interest in this product. Exchanges are not idiots; they're going to go where people are interested in. So CME Group clearly following that trend there. Hopefully, we'll see some Bitcoin options in the near future. Wouldn't that be a fun thing, Mr. Nick?
Yeah, I think again, not knowing anything, but I think this will be the extent of what you're going to see for a period of time from the CME. I think Brian Durkin was just on like Bloomberg TV saying they're going to wait and see on the Bitcoin derivatives. So I think this was sort of a hat in the ring type of, and this reference rate is in Quick Strike under QuickCoin, and the current real-time index is around 41.67 right now. There are other probably more adept indexes out there than this, so we'll start talking about that as we go a little bit more deeply into it in Quick Strike, the platform itself. But based on the CME leadership, it doesn't sound like they're going to do anything in the near term. At least that's what was said on that Bloomberg TV interview. CBOE, who knows, they are partnering with that Winklevoss company, but outside of that, you're going to see more cryptocurrency information coming out of Quick Strike. So that's something that we could start to talk about in general, Mark, and that will probably be some very useful information and tools in the next quarter. We're already into the fourth quarter. On Monday, we start the fourth quarter. So definitely we're going to see some tools for cryptocurrencies in the fourth quarter from us. So CME getting started. I mean, they have the index. I don't know if they'll be doing any derivatives, and I'm just going off of what the president of the company said. CBOE will see how long it takes for them to get out there, and there are other exchanges that do that stuff, but we're gonna probably provide some good index information coming up here real soon.
There you go. You can't get the data. You can get it over there at Quick Strike. And you're right. I think I heard Brian make similar comments a week or two ago at the CTA Expo. Something they're gonna kind of play the wait and see game there. Makes sense. Let some other exchanges test the waters first, and then you can jump in when it's a proven entity. Still a lot to be shaken out on the Bitcoin. Look at the comments coming out of Morgan and Jamie Dimon a couple of weeks ago saying it's all pretty much fluff and money laundering and criminality, and stuff got crushed as a result. And of course, central banks threatening to create their own. So there's still a lot of volatility in that space, which could be attractive or perhaps not. Interesting stuff. But it looks like some products on the horizon, maybe not from CME, but others so if you are out there, chomping at the bit, I know there are a lot of you, then there will hopefully be some pending approval that you guys can try out, hopefully even maybe by the end of the year. All right, and let's see. Last but not least here, we got O'Neill. O'Neill wants to know, this is perfect for you here, Mr. Nick, talking about tools on the CME website. Can you break down how the FedWatch tool works? Thanks, and good shows. Well, I'm glad you like the shows, Mr. or perhaps Mrs. O'Neill. Mr. Nick, you guys run the FedWatch tool over there now at Quick Strike. So why don't you break down for us how it works?
Yeah, so that's a great question. So if we go out there and look, if you're out there now or this weekend or next week, if you look at the next meeting, it's a November 1st meeting, and what you're going to see is a bar that's 98% tall and 2%, another bar that's 2% tall. So currently, the target rate, we're in the 1% to 1.25%. So when you see a big chart like that with 98%, there's basically saying that there's not going to be much chance that we're going to change from where our current target rate is right now. So we're basically the November meeting is going to come and go, and there's going to be no action from the Fed governors. When you start to move out on these tabs, like December 13th, you're going to see that we jump. That bigger percentage comes into the 125 to 150 target rate range, and 1.25, 1.5. So that means that there's a 3 out of 4 chance that they're going to do another tightening at that time. So what the tool does, and you can go out there and take a look at the other tabs on that tool, is looks at the Fed fund futures, and based on the levels of those futures throughout the term structure, it determines what the probability or the expectation is for a particular rate at that given time. We'll go out to that period of time that encompasses that meeting and then come back and tell you what the futures are saying. Something to keep in mind, and another way of also looking at that, you can go out here and like I said, I was at the December meeting and you had like a 1.25 to 1.5. You go out to the Jan meeting, it's still the highest percentage is 1.25 to 1.5. Same thing out to the March, and we go out to the May. We still see 1.25, 1.5, all the way to the middle of next year, where we start to finally see that there's a little bit of traction for another quarter percent tightening away from what's expected to be the target rate come December of 1.25, 1.5. So, but what's interesting is we see those and we see what that looks like over time. But what you can also do is go to the dot plot section of the FedWatch tool. And what that will do is it will give you an indication of what the Fed governors think the rate is going to be at a particular time. And it's my understanding that right now, the divergence between the Fed governor opinion of where rates are going to be at a particular year versus what the futures are saying is the widest it's been in a long, long time. A long time, that's kind of a bogus thing to say, but years. So, or maybe a decade, whatever. So right now the Fed governors are more optimistic of higher rates than the futures themselves are. Now, we just got the September 2020 future on here, so we're able to, I don't even know if that meeting's on the tool yet, but it'll roll on there very shortly. But Fed governors are a lot more optimistic for tightening than the actual futures and the trading public are. So that's another way to kind of use the tool and take a look at things. But everything's based off the futures. We have a lot of good stuff on this tool as well. You can get historical for how the meetings have moved and how that basically saying the futures over time's changed. So you could see a historical chart and how the meetings have moved to set the expectations differently. You can also get downloads for everything for all of the meetings and see how that calculation occurs as well. So it's a great question. The tool is very popular, especially around the Fed meetings. And we rebuilt this for the CME about, I think we went live about maybe, 3 to 6 months ago, but we are glad to be a part of such a popular tool on the exchange site.
It's time for your questions, comments, and insights. It's time for...
There we go. That would be the right music. All right. That means we're done. That's the end of TWIFO, listeners. Glad you could join us. I think most of you, hopefully the stream worked out. If not, if some of you still had issues, of course, check it out the way most of you guys do over there on the old podcast. You can get it at theoptionsinsider.com or via wherever your favorite platform of choice is, iTunes, TuneIn, Stitcher, so on and so forth. Also via our mobile app, available in all the major app stores. You got to type in Options Insider Radio Network. I know it's a pain. Just do it once. You get the app. You get everything. So don't worry. But before we go, let's go back around the horn. Mr. Nick, you just talked about the FedWatch tool. You guys are always talking and cooking up cool stuff. What's up your sleeves over there at Quick Strike, sir?
Okay, so I'm going to need a few minutes. I'm going to need the rest of our hour here to maybe go through some stuff.
Oh, good stuff. I'm excited.
Yeah, so the big news is this weekend we'll be doing a build. You don't need to look until Sunday afternoon because it won't be out there till then. The Quick Strike Essentials tool will now get a free version of our Quick Vol tool. Okay, so that means you're going to get to see, we're going to have it limited to 1 month worth of historical data for everything that we have for the benchmark products. So that includes all the at-the-money volatility stuff, the skew, the risk reversal, the butterfly, the call skew, put skew, the quick skew, the what we talk about all the time, and as well as historical expirations and the counts of maturity and volatility cone stuff. So you're going to get a nice taste of everything that's available in the tools that you can buy from, and they'll be available at some point in the next quarter from the CME Group website, as well as from Inside Quick Strike Essentials, as well as from Inside Quick Strike. So what we've basically done is giving everybody a look at the tools and what's available. And more importantly, you're going to see that data, not only that you're going to be able to see it from a chart standpoint, but then you're going to have the ability, if you would like to get access to that as a download, there is going to be a facility for you to do that as well. So, and that is going to be either based on an ad hoc purchase or something that you can buy a big subscription and get all the download volatility data that we have. So that's kind of the big news for the release this week, as well as, we're doing another release for the paid stuff as well. And there's a lot of new good stuff coming out there as well in terms of tools and information. And then probably end of next month, we're going to see the new sort of more professional trade builder. I think people are going to really like it. It's going to be basically this on-the-fly a spread builder and calculator, and be able to do some really interesting analysis with that. So stay tuned. But the big one is Quick Strike Essentials getting a free version of QuickFile. And I think that now there should be no reason not to register for the free stuff, because you're basically getting a ton of information for nothing.
Crazy. You guys, I've always said you guys offer one of the crazier values out there, because a lot of it's free. And now you're just adding to it. If you guys haven't done so, you're crazy. Kick the tires over there, cmegroup.com/TWIFO. CME page where you can find a lot of Nick and his team's Quick Strike stuff. A lot of it's embedded over there, including in the FedWatch tool and other cool stuff. So kick the tires and light the fires, as they like to say. If you like futures options, listen to the show. I'm guessing you do, and you're not using this stuff, particularly when a lot of it's free. You're kind of crazy. So check it out. Easiest place, cmegroup.com/TWIFO. You can follow along from there and log in and upgrade to the Beyond the Essentials as you need, and so on and so forth. And on behalf of Mr. Nick and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing. Of course, for sending in such great questions. We love them. Keep them coming. And we'll see you next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by Quick Strike, options pricing and analysis software. Quick Strike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quick Strike has you covered, with market data reports ranging from open interest to the term structure of volatility. Quick Strike is the perfect addition to your trading toolkit. Learn more about Quick Strike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.